everyone, Umar here. At one time, the goal of making $100 a day seemed almost unattainable to me. I looked at charts, tried different approaches, rushed, made mistakes, lost money, and every time I thought that I was just missing some secret tool. But over time, I came to understand that the market does not reward hassle and excitement. It rewards those who know how to read the content and wait for the right moment. Today, in one evening, I managed to make $1,200, and it wasn't luck, a random entry, or the stars aligning. It was the result of a clear system, discipline, and understanding of when the market is really ready to move. Many people are looking for a magic button, or the perfect signals, or the truth that is not the number of the trades and matters, but their quality. In this video, I will show you the strategy I used, analyze my entries, and explain why momentum has become the key indicator for me, helping me distinguish real movement from empty noise. Momentum is an indicator of movement strength. It's not needed to guess the market or to confirm a beautiful picture on the chart. Its task is simpler and more important, to show whether the movement has energy or whether the market is already beginning to run out of steam. The price may rise and update highs, but if momentum is falling at that moment or is staying below 100, it means that the growth is due to inertia. There is no more pressure and the movement becomes vulnerable. Conversely, the market may look sluggish and unexpressive, but when momentum rises and crosses the 100 level from bottom to top, it often means that the momentum is just forming. In my trading, I use momentum as a filter, not as an entry point. It does not tell you where you should definitely enter. It shows you where it's not better to enter. Even if everything looks logical in terms of structure, this greatly simplifies decision making. You stop chasing every signals and start working only with those situations where the market is really ready to move. Most losses occurs precisely because of entries at the time when the movement has already ended, and the momentum helps to avoid this. My AI bot and traders in the VIP group use momentum as a filter for trades. It shows where not to enter, even if the signal seems perfect. I share this strategy template on Telegram, and you can connect to copy trading or use the both signals as well. So everything is open, no frills. The link is below the video. Here is the first trade. Before entering, the market looks fairly neutral. The price was moving without a clear direction, and based on the candlesticks alone, it was impossible to tell whether there was real movement or just noise. At times like this, I was look at the momentum because it shows the state of the market rather than its direction. So at this point, the momentum line approaches the 100 level and breaks through it upwards. For me, this means that the market has started to accelerate and there is momentum in the movement rather than just random fluctuations. However, I don't enter immediately at the moment of the breakout. False breakouts are common. So it's important to wait for confirmation. In this trade, the candle closed confidently in the direction of growth without a sharp return down, and the next candle continued the movement. After that, I entered a long position for 3 minutes. I choose this time frame consciously. I take the first impulse while it's still fresh and do not try to squeeze more of the market, and then it's ready to give at the beginning of the movement. After entering, the price behavior was smooth and calm. The candles moved upward without deep pullbacks. The shadows were minimal. Momentum remained above 100 and showed no signals of weakening. This is an important point. As long as the strength in the market remains, there is no point in rushing and exciting prematurely. The trade calmly reached an end and closed in the black. The results was 85%. This situation clearly shows how momentum helps you enter the market not based on emotions, but at the moment when the movement is really just beginning. Here's the second trade, which is all about discipline and ability to not enter. Even when the picture looks tempting, at this moment the price continued to rise. The candle looked confident, and from the outside, it seemed that the growth was about to continue. For most people, this is exactly the moment when they want to press the button and jump on the bandwagon. But if you look not at the prices, but at the momentum, the picture was completely different. The line had been above 100 for a long time and began to flatten out, then slowly decline. This is a sign of overheating. The market is still growing, but the momentum is gradually fading. In such a situation, I never enter the market because I understand that the buying here means joining a movement that's almost over. It doesn't matter for me that the price goes up a couple of points. What matters is that there is no longer any momentum for a normal continuation. I just watch and wait. After a while, momentum finally drops below 100. This is a key moment for me. The market is officially coming out of its acceleration phase, and the likelihood of a reversal or a deep correction increases sharply. Almost immediately after that, the price stops updating its highs. Weak candles appears, and the first signs of pressure from above appears as well. The growth breakdowns, and the market begins to turn downward. This is where it becomes clear why sometimes the best deal is the one that you don't open. While the crowd was buying on the last candles, the market was already running out of steam. The situation clearly shows that it's not important just to see signals, but to understand the state of the market and feel the moment when the majority is already lagging behind with your decisions. Here is the third trade. Everything happened quickly and very demonstratively here. Before entry, the market looked uncertain. After growth, the price began to treat water, momentum became erratic, and attempts to continue the upward movement ended in pullbacks every time. At such moments, many still hope for the trend to continue because visually it seems to be still there. But I look at the momentum again and it gives me a key clue. At some point, the momentum line crosses the 100 level from top to bottom. For me, this means one simple thing. Buyers are no longer in control. The momentum is gone and the market is entering a downtrend. I don't wait for the price to fall nicely or break through certain levels. What matters to me is that the structure of the momentum has already changed. After crossing 100, I wait for a normal downward cancel to close without a sharp buyback. That's exactly what happened in the trade. So I opened a short position after entering the market, worked out very cleanly. Almost immediately, 3 downward candles appeared without deep reversal or payback attempts. Momentum continued to move below 100, confirming the sellers were indeed in control. The trade did not require any intervention. Everything happened logically and calmly. As a result, the position closed in the black with a result of 70%. This trade clearly shows that sometimes you don't need to guess or analyze the market too much. It's enough to understand what has the power at the moment and simply follow the structure of the movement. If we summarize the entire trade, one simple thing becomes clear. The decisive factor was not beautiful candles or guesses about the direction of the market, but the understanding of the strength of the movement. Momentum allowed us to distinguish the beginning of the impulse from its end in the time and not to enter the market when the movement was already running out of steam. In the first and the third trade, the entry was made at a moment when the momentum was just appearing or shifting to the sellers. So the market worked based on the movement quickly and cleanly. In the second situation, the decision not to enter preserved capital and showed that the discipline is sometimes more important than the trade itself. These examples clearly show that the stability in trading is based not on the number of entries, but on the quality of the decisions. When there is a clear filter of strength, the hustle and bustle and the desire to constantly be in the market disappears. You simply wait for the moment when the conditions coincide and act without emotion. It's this approach that over time leads to calm trading and predictable results. Momentum is not a magic or secret tool. It's simply a way to notice the moment when the market stops pushing the price forward and begins to lose momentum. When you start to see the transition, a lot changes. You stop guessing, getting nervous, and reacting to every candlestick. You begin to understand the market moves in phases, and each phase has a beginning, a development, and an end. At this point, trading ceases to be a game of emotions and turns into a calm work with logic and movement structure. All the trades you have seen in this analysis are based on the approach, not on trying to catch the maximum or minimum, but on the ability to recognize in the time where the strength appears and where it goes. This gives confidence in decision and removes the fuss. You no longer chase the market and try to prove to yourself that it will definitely work now. You just wait for the right moment and act when the conditions are right. If your trading logic appeals to you, I show how the approach works in real life on my Telegram channel. There you will find a strategy templates, analysis of live trades, and access to an AI bot that helps you track impulses and filter weak situations before you even enter the market. This is not about promises and big words, but about a clear system and practice. If you want more of these analyses and real strategies without any fluff, like the video and write about it in comments. The link on the Telegram is below.